When you're planning for retirement or already retired, your portfolio should do one key thing: let you sleep at night. That means generating reliable income, keeping up with inflation, as well as protecting your capital through whatever the market throws at you. The good news: you don't need a complex 37 stock portfolio or the hot growth picks of the week. With the right combination of ETFs, you can build a stress-free, low-maintenance retirement portfolio that pays you monthly and holds up market volatility. So let's break it down. So this portfolio is built around four main objectives. Number one is going to be reliable dividend income. Number two, high monthly cash flow. Number three, inflation protection and growth. And number four, capital preservation. Now to hit those goals, we split the portfolio into four parts. We're going to allocate 40% to our dividend income. We're going to allocate 20% to high monthly cash flow, 20% to inflation protection, and 20% to capital preservation. This mix balances income with growth and safety. It's designed to support withdrawals while still growing your capital over time. So our dividend income core is going to be the backbone of our retirement income. It is going to provide you with steady paying dividend ETFs that focus on high quality US companies. Here are some of the recommended holdings. We have SCHD at 15%, which is going to be the Schwab US Dividend Equity ETF. This ETF focuses on companies with strong fundamentals and a history of growing dividends. It has a very low cost, only 0.06%, and it is very high quality. The next holding is going to be DIVO, 10% allocation, which is going to provide you with consistent monthly income. This ETF is the Amplify CWP Enhanced Dividend Income ETF, and it combines blue chip dividend stocks with tactical covered call writing. And this is great for consistent monthly income. And the third holding is going to be VYM at a 15% allocation, which is going to provide you with a reliable and diversified income. This ETF provides you with broad exposure to high-yielding US companies for a reliable diversified income. And just like SCHD, it has a very low expense ratio of 0.06%. So in the dividend income core, we are going to deliver dependable cash flow with the potential for some capital growth, even during rough markets. So if dividend ETFs are the base layer, covered call ETFs are going to be the income booster. These funds own high-quality stocks and sells options to generate extra income. You sacrifice a bit of upside growth in exchange for high monthly yields, often in the 7 to 12% range. Here are two of the recommended holdings, JEPI and JEPQ, and you can allocate 10% to each of these funds. JEPI is an income strategy based on the S&P 500 index, and it is the JP Morgan Equity Premium Income ETF with a solid Morningstar rating of 4 stars. This is a more conservative option-enhanced income strategy, and it holds the S&P 500 stocks. Next, we have JEPQ, which is the same approach, but with the NASDAQ 100. This is the JP Morgan NASDAQ Equity Premium Income ETF. This ETF holds stocks in the tech-heavy NASDAQ, and it sells covered calls against those shares. So this has slightly more growth, and it has strong income potential. And because it is more tech-heavy, it is a little bit more volatile than JEPI. So the covered call income is going to give you monthly income checks, which are ideal for retirees managing monthly expenses. Just because you're retired doesn't mean your money stops growing. In fact, with people living longer, your portfolio needs to keep up with inflation and possibly last 30 plus years. And that is where the growth and inflation protection comes into play. Here are our recommended holdings. We have VU or VTI at 10%, which is going to provide you with broad US stock market exposure. VOO is the S&P 500 index, and it has a very low expense ratio of 0.03%. This is going to give you exposure to the top 500 US companies. And VTI is the Vanguard Total Stock Market Index, which is also going to have a low expense ratio of 0.03%. And this is going to include all of the US companies. The performance on VOO and VTI are very similar, so you can't go wrong choosing either of those ETFs. They are going to give you long-term growth exposure to the biggest names in the economy. Next, we're going to go over VXUS, which is going to give you international diversification. This ETF basically adds global diversification and reduces your United States only risk. And third, we have VNQ, which is going to provide you with income generating real estate. VNQ is the Vanguard Real Estate ETF, and it provides exposure to income generating real estate, which is a very good inflation hedge. So the purpose of this allocation is it's going to keep your portfolio growing, it combats inflation, and supports future withdrawals. And fourth, we have defensive bonds and cash. So every solid retirement plan needs some cushion. Bonds and cash equivalents reduce overall volatility and gives you dry powder during dips. This also provides capital protection. So here are some of the recommended holdings. First, we have BND, which is going to be government and corporate bonds. And BND is yet another Vanguard ETF. It is the Vanguard Total Bond Market ETF, and it's going to give you exposure to those government and corporate bonds with a very low expense ratio of only 0.03%. Next, we have TLT or AGG at 5%, which is going to be longer term bond exposure. TLT is a fixed income iShares 20 plus year Treasury bond ETF. This ETF gives you exposure to long-term US Treasury bonds, and it targets access to specific segments of the US Treasury market. And third, we have SHY or SGOV at 5%, which is going to provide you with short-term Treasury bonds. This is great for parking cash while earning yield. SHY is going to be the iShares 1 to 3 year Treasury bond ETF, and SGOV is going to be the iShares 0 to 3 month Treasury bond ETF. These short-term Treasury bonds act similar to a high-yield savings account, but in some cases it may earn higher yield. So this allocation is going to provide you with safety, stability, and income, especially useful in bear markets. Now let's go over a sample $1 million allocation. This is just a hypothetical example. So let's say you've got $1 million saved for retirement. This is how a portfolio could look. In our dividend core category, we're going to have an ETF mix of SCHD, DIVO, and VYM. And we're going to allocate 40% or $400,000. And the dividend yield of this category is going to provide you with dividends between 3.5 to 4.5% annual yield. Next, we have the covered call income category, which is going to include JEPI and JEPQ, and we're going to allocate 20% or $200,000. And this category is going to have a high yield, so it's going to be between 8 and 10% annually. And those dividends are paid out monthly, which is really going to be good for paying expenses. And in our growth and inflation category, we have VOO, VXUS, and VNQ at an allocation of 20% or $200,000. This is going to provide us with that upside, and it's going to have a lower dividend yield of only 1.5 to 2.5%. This is going to be especially useful during bull rallies, so you have that upside potential and you don't miss out on any future gains. And our last category is going to be the bonds and cash category, which is going to include BND, TLT, and SHY, and we're going to allocate $200,000 or 20%. This is going to be our safest category, and it's going to provide us a yield between 3 and 4%. So with a sample $1 million allocation, our estimated monthly income is going to be between $3,000 and $5,000, depending on the yield mix. This portfolio is designed to generate reliable income while also preserving capital and maintaining growth exposure. Now, if you're in your 40s or early 50s or even younger, you may want to allocate more into growth, especially VOO, the S&P 500 index, and you would want to invest less in the bonds and cash category. This is because you have more time for your portfolio to grow and you can withstand those volatility markets a little bit better. Now, if you are retired or around 65, you would want a heavier covered call and dividend core category, as well as more in the bonds and cash. This is because you're relying on that dividend income and you have more bonds for downside protection. You also don't want to take on as much risk because this is your retirement portfolio. So overall, the best retirement portfolio isn't the one with the highest return. It's the one that you can stick with through bull markets, bear markets, and everything in between. This ultimate ETF mix offers monthly income, low volatility, long-term growth potential, all without the stress of constantly managing individual stocks. So let your portfolio work for you, so you can focus on actually enjoying your retirement.